A colossal reevaluation is underway. This represents a key development for those invested in the system's evolution.
The king of dividend ETFs, a leading investment fund, has just made a shocking move. Get ready for change. Prominent names like AbbVie and Cisco are being entirely removed from its esteemed portfolio. Meanwhile, unexpected newcomers like United Health and Macy's are now making their grand entrance.
Is your current portfolio under threat by these significant changes? It's time to find out. Or is this a golden opportunity to scoop up undervalued shares? Let's dive deep. Don't look away. We will dissect this fund's latest strategy, crucial for passive income. This analysis will help you optimize your passive income stream starting today. Stay tuned. First, let's understand what SCHD is all about for those new to dividend investing. SCHD is Schwab's U.S. Dividend Equity ETF, tracking high-quality dividend-paying companies. It's primarily designed for investors seeking consistent income and long-term growth potential. But this fund is more than just dividends. It's a strategic tool for balancing portfolios.
Many growth investors are heavily concentrated in the technology sector, creating risk.
Over-reliance on a few mega-cap tech stocks can lead to an unbalanced and vulnerable portfolio. This fund offers crucial diversification, providing exposure to stable, profitable dividend payers. It helps temper volatility and adds a layer of stability to an otherwise growth-focused portfolio. Now, let's delve into the rigorous rules this fund follows for selecting its portfolio stocks. First and foremost, a company must have a continuous dividend payment history of at least 10 years. This ensures that only proven, reliable dividend payers are considered for inclusion in the fund. Second, a minimum market capitalization of $500 million is strictly required. This criterion ensures the fund invests in established, financially sound companies with significant market presence. Next, stocks undergo a rigorous screening based on several key fundamental financial metrics. The debt-to-cash flow ratio is crucial, indicating a company's ability to manage its liabilities. A lower ratio suggests stronger financial health and less risk for dividend sustainability. Return on equity, or ROE, measures how efficiently a company uses shareholder investments to generate profits. A consistently high ROE signifies strong management and profitable operations, essential for growth. The current dividend yield is, of course, a primary factor. It's about generating income. However, it's not just about the highest yield. It's about a sustainable and attractive yield.
The 5-year dividend growth rate ensures that the company's payouts are increasing over time.
This indicates a growing, healthy business that continually rewards its long-term shareholders. These financial metrics are combined to identify companies that are not only dividend payers, but also high quality. Finally, a critical rule for diversification. No single stock can exceed 4%.
This ensures no individual company dominates the portfolio, reducing specific company risk. It prevents overconcentration and maintains a balanced, diversified exposure across all holdings.
This careful weighting mechanism is key to this fund's stability and consistent performance. So, this fund's selection process is robust, focusing on both current income and future growth. Let's now analyze the most significant changes in this particular investment fund's 2026 reconstitution. We'll begin with the companies that were removed from the highly competitive SCHD index.
ABVI, a previous stalwart, was notably removed from the fund, surprising many investors.
The primary reason was its rapid share price increase over the last investment period. This surge in price unfortunately led to a significant reduction in its overall dividend yield.
It no longer met the fund's specific criteria for attractive dividend value. The rules are strict. This highlights this fund's commitment to its methodology, prioritizing current value and yield. A major corporate entity was another prominent removal, following similar quantitative reevaluations. Beyond individual stocks, the fund significantly reduced its overall weighting in the energy sector. This adjustment reflects evolving market dynamics and the fund's continuous rebalancing approach. Now, let's turn our attention to the exciting new additions strengthening SCHD's portfolio. A major healthcare provider is a significant new addition to the fund's portfolio. UNH is a high-quality company, known for its robust business model and consistent performance. It now offers an attractive valuation, meeting the fund's criteria for both quality and price. A leading technology firm also joins the ranks, adding another layer of diversification and value.
QCOM boasts strong fundamentals, a solid balance sheet, and a track record of innovation. Its current valuation became appealing, making it a fitting choice for the dividend fund.
These additions demonstrate SCHD's active strategy to identify valuable dividend growth stocks.
These changes are expected to contribute positively to the fund's long-term performance and stability.
Overall, the reconstitution reflects SCHD's dynamic approach to maintaining its high standards. How does SCHD stack up against other popular dividend-focused ETFs in the market? Let's first consider the Vanguard Dividend Appreciation ETF, known as VIG. It's a strong contender. VIG primarily focuses on companies with a history of increasing dividends, emphasizing growth over yield. Then there's the iShares Core Dividend Growth ETF, or DGRO, another popular choice. DGRO seeks a balance between dividend growth and a reasonable yield, with broader selection criteria. SCHD consistently stands out by uniquely combining high dividend yield with strong dividend growth.
This winning combination of immediate income and future payout increases makes it exceptional.
For many investors, this fund offers the best of both worlds, truly earning its reputation. Finally, let's explore some deep investment thinking sparked by latest portfolio adjustments. First, a word on diversification. Avoid spreading your investments too thinly across too many stocks.
Over-diversification can dilute your best ideas and hinder significant portfolio returns. Quality over quantity.
A practical guideline: limit any individual stock to no more than 10% of your total portfolio. This rule helps manage individual stock risk without sacrificing potential upside from conviction buys. Consider the broader market context. The broader market index is currently very concentrated.
An astonishing 34% of the S&P 500 is now dominated by a few mega-cap technology stocks.
This heavy weighting creates a significant single-sector risk for many passively invested portfolios.
Here, this fund serves as a perfect counterbalance, protecting your portfolio from this tech overexposure.
It diversifies your holdings into other robust, dividend-paying sectors, enhancing stability.
Integrating this fund can significantly mitigate the risk associated with an overly tech-heavy market.
Now, for a golden rule that too many investors unfortunately tend to ignore. Do not buy a stock simply because its price is currently on sale or dipping. A low price doesn't automatically equate to a good value. It could be a value trap. Instead, always buy based on the underlying quality of the company. Research is paramount.
And ensure the stock's current valuation makes sense relative to its intrinsic value. Be smart.
It's the powerful combination of quality and attractive valuation that truly drives long-term success. Apply these principles, and your dividend portfolio will surely be well-positioned for future growth. Thank you for watching. Stay informed, invest wisely, and secure your financial future.